the moment liquidity replaced prudence. There was a point when caution quietly stopped being the primary defense of the banking system, replaced instead by the belief that access to liquidity could solve almost any problem, no matter how quickly it appeared or how deeply it was rooted. This was not a reckless decision made overnight, but a gradual shift in mindset, where banks, regulators, and markets began trusting speed and availability of funding more than judgment, restraint, or long-term balance, because liquidity felt measurable, controllable, and endlessly expandable. To understand why modern banking crises now revolve less around insolvency and more around sudden freezes, we need to return to a moment when liquidity became the system's preferred substitute for prudence, because that same substitution still defines how stress is managed today. For much of banking history, prudence shaped behavior. Loans were evaluated carefully. Funding was matched to duration. Risk was avoided because recovery was uncertain. Liquidity existed, but it was scarce by design. Access was limited. Costs enforced discipline. Running short of cash carried real consequences. Over time, this relationship reversed. Centralized markets deepened. Funding channels multiplied. Liquidity became abundant, fast, and responsive. Banks learned that short-term funding could always be rolled. Markets learned that stress would be met with support. Confidence grew not from restraint, but from access. This transformed decision-making. The question shifted from whether an exposure was safe to whether it could be funded, from whether risk should be taken to whether liquidity would be available if needed. As long as funding flowed, positions felt manageable. Duration mismatches appeared harmless. Concentration seemed temporary. Everything depended on continued access. Regulatory frameworks adapted as well. Stress tests emphasized liquidity coverage. Facilities expanded. Backstops multiplied. These tools reduced panic. They prevented immediate collapse. They kept markets functioning. But they also changed incentives. Prudence no longer limited risk. Liquidity replaced it. Banks optimized for funding access rather than balance. They held assets that could be financed easily, not necessarily those that could endure stress. The system felt modern, flexible, resilient, but beneath that flexibility, something fundamental had been traded away. Judgment had been replaced by assumption. An assumption only holds until liquidity disappears. That moment was approaching. As liquidity took center stage, the system slowly reorganized itself around the assumption that funding would always be available somewhere, from someone at some price, transforming what had once been an emergency resource into a routine operating condition that quietly reshaped how risk was evaluated and justified. Banks began structuring balance sheets with confidence that short-term markets would remain open, that refinancing would be smooth, and that any temporary disruption could be bridged with speed rather than restraint, making duration mismatches feel manageable as long as liquidity lines existed on paper. This did not feel careless. It felt efficient. Assets could be optimized. Returns could be enhanced. Idle caution could be replaced with active positioning. Markets reinforced the shift. Institutions with strong liquidity access were rewarded. Those that appeared constrained were penalized. Funding availability became a signal of strength. Risk management adapted accordingly. Scenarios focused on market access rather than asset durability. Stress was modeled as a funding problem, not a valuation problem. Confidence rested on continuity. Over time, prudence lost its urgency. Holding excess buffers felt inefficient. Avoiding exposure felt unnecessary. As long as liquidity could be secured, patience seemed optional. The structure of banking followed this logic. More reliance on wholesale funding, more dependence on short-term instruments, more confidence in rapid response mechanisms. Regulators supported the transition. Liquidity coverage ratios were emphasized. Emergency facilities expanded. Communication strategies focused on reassurance. Each improvement reduced the chance of immediate panic, but each also increased dependence on speed. The system became faster, but thinner. When small disruptions occurred, liquidity absorbed them. Markets reopened. Funding returned. Confidence reset. Each recovery reinforced belief. If liquidity worked before, it would work again. History appeared to confirm the strategy, but this belief masked a vulnerability. Liquidity solves timing problems. It does not solve solvency. It delays reckoning rather than preventing it. As balance sheets leaned further into this assumption, risk accumulated in forms that liquidity could not neutralize. Valuations stretched, correlations increased, behavior aligned. The system was calm, but it was no longer cautious. And once prudence fades, liquidity becomes a last line of defense. That line would soon be tested. The conflict emerged the moment liquidity was forced to perform a role it had quietly replaced. When markets discovered that access to funding, no matter how fast or abundant it once seemed, could not instantly restore confidence once doubt began spreading through balance sheets, counterparties, and expectations at the same time. As stress appeared, banks moved exactly as the system had trained them to move, drawing on lines, rolling short-term funding, and activating contingency plans designed for temporary disruption, only to realize that when everyone relies on the same liquidity channels, those channels themselves become points of failure. Funding that was assumed to be available hesitated. Markets widened spreads without warning. Counterparties paused, recalculated, and waited. Speed, once the system's greatest advantage, turned into its greatest vulnerability. Prudence could not be summoned at the last moment. Balance sheet discipline cannot be improvised under pressure. Assets that were easy to finance during calm periods became difficult to value once liquidity retreated even slightly. Banks discovered that liquidity does not eliminate risk. It concentrates timing risk. It compresses decision windows. It forces reaction instead of reflection. As withdrawals accelerated and refinancing slowed, behavior synchronized. Institutions sold similar assets. Hedging intensified. Protective actions reinforced one another. What followed was not insolvency in the traditional sense, but instability driven by momentum. Prices moved faster than assessments. Confidence weakened faster than fundamentals justified. Liquidity drained precisely because it was needed most. Regulators responded decisively. Facilities expanded. Collateral rules adjusted. Assurances delivered with urgency. These actions stabilized markets, but they also confirmed a deeper problem. Liquidity had become the system's primary shock absorber, and shock absorbers were out. Each intervention arrived larger and faster than the last. Each response reduced tolerance for delay. Each episode narrowed the margin for error. The conflict was no longer about whether liquidity could be provided. It was about whether reliance on liquidity had replaced the discipline that once limited exposure in the first place. The system had become exceptionally good at moving money, but it had become dangerously poor at deciding when not to. The climax arrived when the system was forced to confront a truth it had long postponed: the realization that liquidity, no matter how abundant, fast, or forcefully delivered, cannot substitute for judgment once confidence fractures and timing collapses across institutions at the same moment. Liquidity had kept markets open. It had prevented immediate collapse. It had bought time again and again. But time alone does not correct imbalance. It only delays it. When funding replaced prudence, restraint lost its role. Decisions were justified by access rather than durability. Exposure expanded because it could be financed, not because it could be absorbed. In that moment, liquidity stopped being a safeguard. It became a dependency. A system that relied on constant motion could not tolerate pause. And pause is exactly what fear introduces. Once markets hesitated, everything tightened. Assets that seemed liquid revealed limits. Funding channels narrowed. Confidence demanded reassurance rather than proof. Intervention restored calm once more. Support arrived. Markets stabilized. But the cost of stabilization had risen again. Each response confirmed expectations. Liquidity would be provided. Speed would replace patience. Support would arrive before discipline was enforced. The resolution is not a rejection of liquidity. It remains essential, but liquidity cannot be allowed to replace prudence. It must support restraint, not excuse its absence. A resilient system does not depend on constant motion. It depends on balance, on buffers that exist before stress, on decisions that assume liquidity may disappear. American banking now operates with extraordinary speed and depth, yet with shrinking tolerance for delay. The system functions, but only as long as funding never truly pauses. The moment liquidity replaced prudence was not a single decision. It was a habit, and habits shape systems more powerfully than rules. So, what do you think? Has speed made banking safer? Or has it simply made hesitation more dangerous? The